The most expensive analytical error in sovereign credit is filing a structural mathematical failure under geopolitical noise. Over the last week, the baseline assumptions underpinning major emerging market debt frameworks collapsed, yet consensus credit spreads have barely moved to price in the new math. Traders reading headlines see diplomatic alliance restructuring and stay positioned. Those reading the fiscal denominators see the framework breaking and adjust, opening up highly asymmetric sovereign credit trades. Take the United Arab Emirates exit from OPEC. Financial media spent the week treating this as a bilateral dispute over production quotas, a Gulf alliance restructuring story. But Abu Dhabi was the swing producer. Their compliance held the price floor together. They have the highest production capacity and the lowest break-even cost, and their departure instantly drops the denominator for global oil supply.
This image highlights the institution where the real impact hits, the International Monetary Fund. Every oil-dependent Article 4 calculation, from Kazakhstan's national fund accumulation to Nigeria's budget arithmetic, requires cartel discipline holding to maintain fiscal solvency. Without that discipline, the price path embedded in those IMF models is mathematically broken. The market is entirely ignoring a structural sovereign credit event. Simultaneously, the Bank of Japan confirmed a hawkish hold. With raised inflation forecasts, 3 dissenting members, and an explicit rate hike signal from Governor Ueda, the central bank's posture has decisively turned. This flowchart tracks where that Japanese policy hits hardest. Cheap yen capital is the primary carry structure funding duration in high-yield emerging markets, flowing straight into bonds for Pakistan, Kenya, and Egypt. Sovereign debt spreads were placed against the assumption of continuous, cheap liquidity from Tokyo. That assumption is now visibly cracked, putting those duration structures at immediate risk of unwind. Beyond liquidity and crude, physical logistics dictate fiscal survival. A frontier sovereign's ability to service its debt requires uninterrupted access to the infrastructure through which its export revenues actually flow. While countries like Mongolia and the Philippines face immediate exposure to transit disruptions from their neighbors, Vietnam absorbs regional commodity shocks through a different mechanism. They recently completed a China visit, securing dedicated rail and airline deals, physically locking in their supply chain. Economies without bilateral infrastructure integration absorb inflation directly through the open market. Without that physical corridor hedge, secondary import cover drops, leading straight to balance of payments deterioration. This chart shows the gap between the IMF's stable oil price baseline and the actual output trajectory following the UAE's exit. We are asymmetric and widening biased on Kazakhstan and Nigeria Eurobonds, trading directly against the broken cartel coordination models. Moving down the curve, we are strictly cautious on Pakistan across the capital structure. The bilateral creditor architecture is already strained, and recent military strikes contradict the peacemaker premium the market currently prices in. Reduce duration exposure in high-carry emerging market frontier credits immediately. The Bank of Japan has provided the clear catalyst to unwind these positions. Conversely, we are constructive on Vietnam and specific ASEAN credits that have established bilateral infrastructure integration into Chinese supply chains. The sovereign credit market is operating on stale data, pricing institutional coordination that no longer exists. That misalignment creates a massive asymmetry between actual risk and current yield. Access the unredacted briefing linked below to immediately download the complete mathematical breakdown and our full updated positioning matrices. Protect your capital by trading the underlying denominator, not the daily headline.